Hi, I'm Garrett Cayet, SFMG's Chief Investment Officer. I want to recap the start of 2023 and touch on some of the items that we'll be focused on in the coming quarters. So to start, the market rally that began in October of last year continued through the first quarter for both stocks and bonds, but not without some bumps along the way. Early gains were driven by declines in several widely followed inflation indicators, along with some surprisingly resilient economic data. That increased investors' hopes that the Federal Reserve could create an economic soft landing where the economy slows but avoids a severe recession and inflation eventually trends lower to their target level. Fourth quarter corporate earnings from 2022, which were reported in January, also helped as the results came in broadly better than expected. But the markets pulled back in February and early March for a few different reasons. First, the labor market actually showed a little bit too much strength. That was interpreted as bad news because the Fed has commented that the tight labor market is contributing to the rising inflation, and so the expectation became that they'll need to be more aggressive with their rate hikes in response. We also saw that the decline in some of the inflation indicators from previous months had begun to stall and in some cases reverse higher. And then the failure of 3 regional banks sparked fears that a regional banking crisis was unfolding. But the Fed and the Treasury were quick to act in creating new lending programs designed to support any stressed banks and prevent bank runs, which helped stabilize the markets. Finally, despite hiking rates again in March, the Fed did signal that they are close to ending their historic rate hiking campaign. And those comments, coupled with no additional large bank failures, helped support a market rebound through the remainder of the quarter. So we've had a strong start to the year, but investors are still facing the highest interest rates in decades, ongoing geopolitical tensions, and an uncertain economic outlook in the wake of a newly challenged banking system. Potential hurdles for markets in the coming quarters may be the U.S. debt ceiling, tensions picking up between China and Taiwan, and tighter lending standards among more cautious banks, which could weigh on access to credit and overall consumer spending growth. These headwinds are concerning, but it's important to recognize how economic data and corporate earnings have held up better than expected and for much longer than many people have expected. And those factors are the real drivers of long-term performance growth. So to wrap up, in addition to the risks that I've mentioned, we're continuing to watch for changes in Fed policy, the stickiness of inflation, and earnings expectations in the coming months to help guide investment positioning. Thank you, and if you have any questions about our outlook or your portfolio, please feel free to reach out to your SFMG team.